Welcome to this training. We're going to talk about financial terms, the terms, the conditions, some of the deal structure terms that every CEO needs to know when raising capital. So a quick summary, this is the time for you to get smart on financial terms so you can know what you're talking about with investors and lenders and all of the different interactions you're going to have with them. And so I encourage you to peruse a few of the startup blogs like TechCrunch and some others, VentureBeat, to learn funding and startup lingo. This will be very helpful for you to just start learning how people speak, especially if you are pursuing a high-tech startup or something that will require significant capital. And the reason for this is the more you know, the better control you will have over your process. The more likely you will be to get favorable term sheets from the different capital sources we're going to show you how to pursue. This will also help you be a smooth negotiator during the closing process as you get more nimble and more powerful in your discussions with these investors. And so let's start with some general terms. And these will just be a few. Some general terms to know. You need to learn about burn rate. And this is really particularly used in pre-revenue companies. And so burn rate describes your monthly expenditures. If your sales are zero and your expenses are, let's say, $20,000 a month, your burn rate is 0 minus 20, you're burning $20,000 per month, negative 20 cash flow. And if you're raising capital, you need to raise enough money to cover your burn rate for the next 12 to 18 months so you can secure additional capital, or you can build a product and start to generate sales and reach cash flow break even. So understand how much money it takes to run your company each month. Next is exit strategy. So if you're planning to sell your company, or you're going to be merging it or buying out investors or taking it public, that's the example of an exit strategy. Getting your money out. A liquidity event is another way to look at it. And so getting your money out of the investment for an investor is really important because they need to know how they get paid. And it's important for investors to see that exit strategy because they need to get their money back, get paid. And obviously they need to generate a big return for their investors. That's the point of them investing. So learn and spend time on thinking about your exit strategy. Going public, it's a big one. A company's IPO or initial public offering in the stock market, like the New York Stock Exchange or NASDAQ, Dow, those are all different parts of the stock exchange. And so most VC-backed company CEOs want a big exit, a big sale of the company. They want to sell it for $1 billion. Or they also want to take the company public as another option to get liquidity, to get the initial investors out. And so going public is a big dream for a lot of entrepreneurs, and I hope you might have something just as big in your mind too. Nothing wrong with that. So that does it for the general terms, and I know there's more, and we'll show you how to find some other resources to get smarter on these terms. Let's next talk about equity terms. So first, what really is equity? Well, equity investors write business checks in exchange for shares of the company. They're going to own a portion of your company. Angels and VCs invest for the equity upside as well. Remember how we talked about them owning, let's say, 20 or 30% or 40% of your company. If you sell it for $100 million, they will get at least that $30 or $40 million out of that 100. And so they're looking for big upside that equity offers. And compared to debt investors, equity investors are not seeking these debt-like returns. They don't just want 8% return on their money as a high-interest bank loan would, or even a private lender who maybe takes 10, 15, even 20%. They don't want that. They want something much bigger, even though it will be more risky. So they're looking for the big 3, 5 to 10 times returns on their equity. They want to invest $1 million and they want to get 3, 5, or 10 million back over time. That's the goal of a good equity investor. And so the value of your equity, the shares of your company, will grow as that company grows its sales, its profits, and its cash flow. As you reduce your debt, if you do have debt, you might be able to use debt to grow even faster, but in general, you need to grow your cash flow, and that will grow the business value itself. Especially as other investors buy in at higher valuations, that will all push up at least the paper value of the company. And your goal, again, is to build a successful, cash flow positive, growing company over time, and the equity investors will be there to support you if you align with them on that interest. And so that's equity. Equity is assets minus liabilities. That's another way to look at equity in the company. And remember, again, equity investors get paid when you sell your company or when they sell their shares to other investors or even to you, or the company pays them dividends as well. So there's, again, 3 to 5 different ways that an equity investor can get paid on their investment. So here's some equity terms that you should know. Angel investor. We're going to talk about angel investors, and we're going to show you how to approach them. It's an individual or group of individuals who invest their very own money in early stage companies in exchange for a share or a number of shares of the company. So just like an equity investor, that's exactly how angel investors will invest for equity. Now, some different forms of equity are common stock and preferred stock. Now, for especially a C corporation, you'll have different forms of stock, and different investors will want different types of stock because they each have different ways of protecting their investment. So different classes of stock will be sold to investors in an equity financing. That's really what you need to know now. Common and preferred are 2 different classes of stock. Convertible note, it's really a debt or a debt-like instrument that is worth a percentage of equity ownership in the company in the future. So in a convertible note capital raise, it's still a security, so you still need to follow the SEC and FINRA laws. But a convertible note is essentially where an investor will write you a check for, let's say, $100,000. And it will typically accrue interest, and it won't be paid each month like a normal loan, though. The goal of the convertible note is to get you capital a little more quickly and with fewer legal documents required, and that debt will convert to equity or shares of the company at some defined future event. We'll get into that once we start talking about angel and VC investors. Incubators and accelerators, they're very popular these days. They're organizations that support entrepreneurs or their businesses with mentorship and office space and training, and they even have demo days and investors. And some examples will be Y Combinator and 500 Startups and even Techstars, which are becoming very big for technology company startups around the country and around the world. So look into incubators and accelerators. We'll show you how to apply and find these different types of entities and support structures as we move on into the course. Non-disclosure agreement, an NDA, sometimes called a CA or confidentiality agreement. It's a legal doc that protects your startup secrets or your company's secrets, and it holds employees responsible to pay damages for leaking those secrets. So if you do start to hire employees, you'll probably want to get an NDA and a confidentiality agreement with them. And also, NDAs are great for certain investor types and definitely vendors and partners. Again, it's all geared towards protecting the intellectual property and the secrets that you're developing as a business owner. Also, you should know about the seed round or the seed stage. That's a term for the first round of venture capital funding for a business venture. It can be from friends and family. It can come from crowdfunding. It can come from angel investors. It could even come from early stage venture capital firms. The seed round or the seed stage is really the first round of capital that you raise to get your business off the ground. And finally, on this page, valuation. What's the pre-money valuation and the post-money valuation of a company? And that's essentially how much your company is worth based on a number of different factors. But when you're raising capital, it's important to know how an investor will look at the value of their company. And that's really putting it very, very simply. It's how much your business is worth. And again, we have a module here that will show you how to use valuation and how investors will look at it and how to support your valuation in a negotiation for equity funding. Other equity terms are preferred stock. We talked about the different classes of shares, but it's a class of equity shares. They're typically used by outside investors, and they contain more terms and protection against loss than common stock. And so, we'll get into the different types of preferred when we start talking about angel investors and venture capital, but this is important to start to learn about right now. Next, we talked about shares as well as stock, but shares require stock certificates. They represent really the ownership or the share in your company. Different classes, we talked about stocks having different classes, including common and preferred. Preference is another term that you're going to have to learn when you start to raise equity capital, especially preferred equity. You need to just understand what the different terms mean when you start to receive term sheets from investors. So preference is really how many times the company pays back the par value before converting their preferred stock into common stock. So think of it this way. An investor gives you $1 million. The preference and the multiple that they want back, they want to receive at least that $1 million back in the event of a company sale or liquidation. And so the preference will simply show you how many times they're going to get that initial $1 million back before they start to share in common stock upside. So that's one example of how preference works. Participating preferred stock. It's a kind of complicated term here, but preferred stock with a specific dividend that is paid before any dividends are paid to common stockholders who are the founders. And so that takes really precedence over common stock in the event of a liquidation. And so this form of financing is used by private equity investors and venture capital firms, and it's actually typically not in your interest to have participating preferred stock because it means that the investor gets paid before you and possibly more than they would if they're not participating. So that is something to watch out for in the term sheets when you start to raise equity financing. Another very common term is interest. You're accruing interest, especially on a loan or on a debt instrument when you're financing your company. Accruing interest, it doesn't necessarily mean that you're making interest payments, but it does mean that you are accruing a larger liability back to that investor in some way, shape, or form. And it adds to the total value that you'll pay them when the company is liquidated, the company is sold, and how the company is valued in the future. So a few more equity terms. Venture capitalist. It's a professional firm that invests money in high growth businesses in exchange for an equity share of the company. And so VCs invest institutional dollars. They don't really invest their own money like an angel does, but they will invest their money on behalf of other investors, other funds, pension plans, endowments, high net worth individuals. They're investing other people's money. And so that's the biggest difference between a venture capital fund and an angel investor. They usually focus on proven or many times early, but many times later stage startups and high growth companies, and they invest greater amounts of money. You typically won't see a VC firm writing a check for anywhere under a couple $1 million, and they certainly do write checks up to 10 to 20 to 50 to 100 to a couple $100 million, some of the larger funds out there. Another term to know is vesting. It's really a defined schedule where founders and employees will remain in the company, and it'll really define how they receive essentially ownership of the shares that they already have. And so it really instills loyalty of the founders and of staff, and it really keeps the company together for a certain period of time. So just think of it, if you join a company and you hear about someone getting 10% of the equity or 5% of the equity, almost always they will have a vesting schedule built in to make sure that if that person leaves in 30 days or even a year or two, they're not going to get the full value of that compensation to start. They need to earn it back over time and essentially own it over time. And that's how vesting works. You also hear the term cliff, and cliff vesting is when someone becomes fully vested or partially vested on a specific date. And if they leave again before, let's say, 1 year has passed, they might get zero equity and zero option value. So again, it's a way to incentivize your both founders, co-founders, early stage employees, almost all employees to stay and actually earn that equity over time so that there's enough to go around, and it will prevent people from joining, taking equity, and leaving without paying for it. So here's an example 5-year vesting schedule. So for example, let's say that you have an investor or you've been growing your business and you hire a new senior executive. You should be putting in a vesting schedule into their employment contract that, again, they don't take all of that equity at first. They need to earn it over time. And so with a cliff, you'll own 0% until you reach 12 months of being in that plan or being an employee. After 2 years, you'll own maybe an additional 25%. In year 2, I mean at the beginning of year 2. At the beginning of year 3 or end of year 2, you'll own 50%, and then 75%, and then 100%. So you will vest over 5 years of being there is really the best way to look at how vesting works. All right, let's take a quick break. I know this is really exciting stuff. Grab a sip of water, and let's jump into debt terms. So what is debt? Well, debt is a financial instrument where a lender will give you money and you will pay them back in a structured format. And typical terms might include fixed monthly payments, just like a mortgage or a personal loan. They could be variable monthly payments where you owe them based on success or sales of the company or on a floating interest rate. Percentage of sales or profits is another way to pay back debt. You might have deferred debt payments with accrued interest, so it might accrue interest. You might pay just the interest back. You might not pay any interest, but the deferred payments are important to learn about as a way to bring on new potential debt investors. Also, debt that has the option to convert into equity upon a future event. It's the example of a convertible debt structure that we mentioned in a couple of slides earlier. So here are some bank lending terms if you plan to take on a bank loan now or in the future. Collateral. Collateral is property, assets, stocks, bonds, property, equipment used to secure a loan. The coupon is the interest rate paid on a note, a bond, or a loan, some form of debt instrument. Debt service. If you're taking on a new bank loan, your banker wants to know that you can pay back the debt and how much cash your business generates in order to have even more confidence that you'll pay back the debt or the loan. So it's a measurement of a borrower's ability to pay back debt, and typically that will be calculated by income divided by the loan payment, and it's expressed as either a percentage or a number. So if you're making 20 grand a month in cash flow and your debt service or the monthly payment you owe the bank is $5,000, then you're making 4 times more, 20 grand, than the $5,000 that you owe the bank each month. So in most banking situations, if you can cover debt by 4 times, you should be just fine to borrow that much debt. Equity, again, the difference between assets and liabilities of a company or a person. Escrow, it's a neutral, safe place for deal funds to be held in reserve by a trust, bank, or attorney to pay taxes or insurance or payments or retained cash or any other debt-related items when they're due. So escrow is really a safe holding place for money when there's a big transaction that occurs, or if there's some sort of contingent liability that the counterparty, meaning the banker, wants to cover. And so many times if you buy a home, you'll be paying your taxes into escrow each and every month, and the escrow company will release the taxes to the city or other entity who you owe money to. Essentially, it's a way for you to make monthly installments to pay a liability that's paid at a term other than every month. So a safe place for money. Some other bank lending terms. Float. Float is the amount of uncollected funds represented by checks in the possession of one bank but drawn on other banks. And it's also the time that elapses between the day a check is deposited, the day it is presented for payment to the bank on which it's drawn. So float is not at all a best practice. In fact, it's actually illegal. An example would be you write a check for $50,000 even though you have 20 in the bank, but you know you have a deposit coming for $100,000. Your float would be the day or two it takes for the check to clear, both the check that you've deposited into your bank, but also takes another day for the check you wrote to clear, even though you wrote the check when you didn't have the money to cover it. So I wouldn't recommend float, but if you are participating in this now, just know that a banker might look at that as a negative. A note, also a bank note, promissory note, loan, or debt instrument. It states the amount, payment terms, and interest that one party pays another. PFS, or personal financial statement. It's really a document. It's really your balance sheet that outlines your personal assets and liabilities, and it's used for bank loan applications because they need to know that you as a personal borrower have the wherewithal to cover the debt and pay the loan back. So the higher the equity, assets minus liabilities that you have, the better your chances are of getting a loan. And there's many other things that go into successfully getting a bank loan, but again, your personal financial statement, your personal net worth is something that a bank will look at. Underwriting, it's the loan approval process and the team at a bank that delivers the final approval or denial for your loan application. And so it also refers to the standards and guidelines that a bank will have to ensure that banks are protecting cash by not writing bad loans to people who aren't going to pay them back. So just know that many times a banker will say, hey, listen, I'm not going to be able to get this through underwriting. We need to see a stronger financial statement or a stronger credit score or even a cosigner on the loan. So that's the underwriting process. So convertible notes are a class of debt investment commonly used by startups to secure investment on an ongoing basis that really defers the sale of equity. And it typically has valuation-related terms in it, but this is a simple definition. Convertible notes will accrue interest. The structure, it's really the note payable that accrues interest and converts to equity, preferred equity, a defined milestone or event. new financing, maybe a specific date or milestone. Again, a convertible note structure is important for angel investors because many times it's an easier, sort of cheaper way to raise capital for the startup. So start to read into the structure of convertible notes. Timing, if desired investors can invest at any point in time. It's another benefit to using convertible notes versus a structured equity raise. We won't get into the details today, but again, it just allows many investors to write checks at will and many startups to raise capital at will, since the legal requirements in the structure are a little bit easier to navigate. And why? Why is this important? Well, when you're raising a round of equity investment, it requires really a defined timeline, a defined closing date. It requires a strict evaluation of your company because you're exchanging shares. You need to be mindful of SEC. You need to file the proper forms with the SEC when you're raising equity, just as you would be with convertible debt also. There's many times more legal processes and costs with equity capital. So sometimes convertible notes are cheaper and easier to raise. And you need to evaluate your situation as well. So I know that was fun, but let's jump into some action items. If you have anything left in you, review Investopedia.com for financial terms and note those that are relevant to your capital raise. And we're talking about terms related to banking and venture capital and private equity and funding and really just accounting and finance in general. And that is really it for the action items. This is more of a research and study guide. Certainly take out a pad and paper or a Google Doc and just write down some of the terms that you need to learn and that are interesting to you. Because again, the smarter you can get on these terms, the better off you'll be when you're looking to raise capital. And when you're in negotiations with these different investor and banker types, again, the more you know about how everything works and how everything sounds and how to speak with these people and these financial sources, the better off you'll be. So that does it for this video. We'll see you at the next one.